Well. Welcome, guys. This is the Engineer of Trades, and if it is your first time here, this is 2025 Trading Lecture Series. If you haven't checked out the other videos, guys, so kindly go back and check Lecture 1 and also the other videos which have been made as a precursor to this trading lecture series. So lecture 2, we are looking at the overview of the different markets, not really an in-depth analysis of the different markets in the trading space. We're just going to have an overview of it. So that will be things like futures market, stocks market, options, and Forex market. We move on to slide 1, and as it has been our procedure to begin with a preamble quote, and this one has been inspired by Albert Einstein. The important thing is not to stop questioning. Curiosity has its own reason for existence. So the same case with trading, the same case with any skill, you have to put yourself on that lifelong learning. Your learning curve should never ever come to an end. Okay, so that also prepares you for this particular lecture, where our intention is to demystify the diverse financial markets. And of course, that is a product of research and curiosity to understand really the dynamics of different markets: futures, options, stocks, and Forex. Very well. Again, the next thing after we look at the preamble quote is we end up looking at a trader's philosophic inquiry. So this is always where we come up with a number of questions which you as a beginner, as an intermediate trader, possibly, or perhaps you're questioning, you're asking yourself those questions, or these are things that you've been pondering or thinking about. Okay, and it is from those questions that then we derive the content of this particular lecture. And so this particular lecture, we are looking at the overview of different markets. So these questions are in that line. So I'm just going to read them out aloud very fast. And of course, we're always guided by the 5 starter questions: why, what, who, when, where, and how. Okay, so why do some markets suit specific trading styles better than others? What distinguishes each financial market? Who are the key players in each market? When is the optimal time to enter a particular market as a new trader? Where do traders typically falter in their market selection and execution? How do risks vary across futures, stocks, options, and Forex market? Very straightforward. So there is not a lot of things that will be explained here, but we're going to check it out in the next slide. Very well. So now here, this is our first in-depth response to the questions that we've already looked at, which are geared at responding to, or rather generating content of our lecture. Okay, and so the question here is, why do some markets suit specific trading styles better than others? Okay, so by now you already understand that there are different markets which are traded in this space. I've been mentioning them, just let me reiterate again. We have futures market, we have options market, we have Forex market, we have stocks market, right? So possibly you might be asking yourself a question: why is it some markets with specific trading style better than others? Why is it that we have some inclination, that there are people who have certain inclination to trade a particular market and not another market? Why is it a particular trading style, a particular strategy, a particular approach, a particular perspective is well suited with a specific market than the other one? And the response we have to that question is definitely it's because of the uniqueness and the differences in each of these markets. So there is a market which is more suited to, which has certain mechanics which suit better risks, and again, which has different opportunities. So maybe that is not coming out quite clearly as I'm saying it. So for instance, as we're going to see it later on, if you compare the Forex market with the stocks market, okay, in terms of opportunities, it is very possible for you to get frequent opportunities in the stock market when comparing it to the Forex market. Okay, that may be debatable and that is acceptable for debate, but with the experience I have, okay, and the time I've been interacting with these markets, that is one thing that I've come to understand, that each market has different opportunities compared to the other one. And the opportunities in the stock market be may be fitting well to a particular trading style, to a particular strategy, compared to another trading strategy in the same particular market. So it is upon the initiative of the trader, you as a beginner trader, you as an intermediate trader, to really understand each different market, okay, and the trading style, your trading approach, and then judge from the word go which one is well suited for my trading style, which is one is well suited for my personality. And then again, why is it that it is important for you to understand the differences between these markets? Of course, it is for you not to have misaligned strategies. You might be having a strategy that suits well options trading. Okay, so for instance, if you are very open to risks, if you are very risk aggressive, okay, if you are risk averse, there is a specific market that may be waiting for you. So assuming you have a strategy that is very risk averse, and then you go to a market that is prone to a lot of risk, clearly you've already fallen into this pitfall of misaligned strategy. Okay, so and if you fall into that misaligned strategy, that will typically lead you into experiencing unexpected losses. But the only way to mitigate those unexpected losses is by you having a very good understanding of, these different markets and the trading style that suit those different markets from the word go. And that's what helps you not to miss out on opportunities from each market. And most importantly, having this understanding really helps you to optimize your capital well, really helps you to optimize your focus and your energy, have that concisive, channeling of energy and capital to that market which suits your trading style. And most importantly, having that understanding helps you, okay, helps you build a sustainable trading career, which is something that we are building from this very moment. The next question: what distinguishes each financial market? Now, you might be expecting that I'm going to look at these differences with a very in-depth eye, but what I'm actually going to do, I'm simply going to give you a bird's overview, a bird's eye view, okay? And then out of there, I'll spark maybe an interest in you, curiosity in you, as we were beginning, the quote from Albert Einstein, to always have that lifelong curiosity. And through that curiosity, you may end up doing your own investigation, your own analysis, your own research into these markets until you come up with something that suits your personality well. So out of these four markets, we begin with Forex market. This is the most commonly known one for most beginner and intermediate traders, okay? And the Forex market definitely involves the trading of global currency pairs. And we have different dynamics here and there. We have classifications of these currency pairs. We have the major ones, we have the minor ones, we have the exotic ones. And for each currency pair, it is traded against the base currency and the quote currency. So for instance, we might be having something like Euro USD, USD JPY, okay, United States dollar versus the Japanese yen, okay. So the Forex market, the underlying thing is it is geared to trading the currency pairs. So if you are someone who is prone to that, who has an inclination to trading the currency pairs, that is something good for you. The next one is the stock market. Now the stock market, it has this frontline connotation of investment or investors, prone mostly to investors. So the basic understanding we have for stock markets is you buying a certain share or a certain ownership of a particular company. It is the same thing. But now, if you are more of a trader rather than an investor, what you typically do, now you're not buying these shares of this particular company to hold for long-term basis, okay? You might be doing this, to take advantage of the different changes in price, whether it is daily, whether it is in sessions, whether it is in a week, whether it is in a month, but your focus is not on yearly basis, those years, someone like Warren Buffett. No, your focus is on the short time price changes, and that could be even a month, that could be even like a number of months, that could be a number of weeks, and then you end up benefiting from that. So if you're that person who has an interest in companies like Meta, in companies like Apple, in companies like Tesla, and you feel you have something there, there is a market that you should pay attention to. And when we are looking at opportunities between the forex market and the stock market poses more opportunities compared to the forex market due to the daily changes in price. It is very unlikely to find more than maybe 1%, 2%, 3% price changes in the forex market, but it is very easy to find 3% changes, 4%, 8%, even 20%. Even sometimes when we are having those outlier days, 50% changes in the price. So that means if a certain stock was priced at 200 USD, maybe by the end of the day, if that particular stock has appreciated by 25%, you may end up finding something like 200 and 25 USD, and that is something huge there. But for the forex market, you may not find that because there is a lot of uh, there is a lot of dynamics in the forex market which inhibit such movements. Okay, remember again, this is where the central banks, this is where the governments are making transactions, and so those currencies have to be those prices have to be kept in a steady way. But for the stock market, anything can happen in time. A particular company might be releasing the quarterly earnings, and the perception that will be perceived by the traders makes that particular stock to skyrocket crazily. Okay, and then the next market there is the futures market. So for a futures market, from the basic word, from the basic interpretation of that very word, futures. Okay, so this is whereby you enter into a contract, and it is a standardized contract. So it is not a contract where you have flexibility of determining the size of your contract. They are standardized, okay, contracts to buy or sell a particular financial asset, a financial instrument at a certain price in the future, okay, and they usually run for uh, for for every quarter, like in the next 3 months. So like right now we are in the month of May, so we are trading. For instance, if we have chosen to trade gold futures, we are using, if you go into the markets, and I'm sorry that I do not have that illustration here, but later on that illustration will be brought on board. So if we are trading the futures of gold, you're going to see something like July, okay, July 2025, the futures of gold, and the abbreviation that is according to that particular one. So again, you may go into that and check more of that. Then the last one is a market which is not commonly understood, and it is one which looks a bit mysterious and a bit complicated, the options market. And here, really, the difference is simply one when comparing it from the futures market. So here we still have the contracts, but now they are derivative contracts. And what they do, they grant you the right compared to the futures, which grants you the obligation. Okay, this one grants you the right to buy a particular asset or sell a particular asset, and then the terminologies here, they go to the next level. So for buys we use calls, and for sells we use puts. But then for that obligation, you have to buy or sell a particular asset. It has to be at a very specific price, which is called a strike price, and it has to be before a certain expiration date. Okay, so I know that sounds somewhat cliche or somewhat complicated there, but again, if you may find that it's something which is worth your time, you may end up investigating that. So we move on to the next one. So who are the key players in each market? This is very direct. So we have different classifications. We have retail traders. Retail traders, typically these are people like me and you who do not have huge capitals and who do not contribute to movements of prices. Okay. And then we also have institutional investors or institutional traders. Now, these are the hedge funds, these are the investment banks, the pension funds. Okay, name them. So these are now institutions with huge capitals. They are participating in these markets, and they contribute to the price changes. They have the ability to contribute to price changes due to the amount of capitals and the amount of money they are moving in these markets. And most importantly, we also have the market makers. Now, these are the providers of liquidity in these markets. Then moving on forward, when should you start trading in a specific market? It is only after mastering foundational skills and aligning with your goals. So, if you do not have a good understanding of risk management, if you do not have a good understanding of trade management, if you do not have a good understanding of the fundamentals of each market. So, for instance, if you've chosen the stock market, you've chosen the options market, and you still lack a good understanding of the those fundamental dynamics of each market, clearly I wouldn't recommend you to start trading a specific market, but it is only after mastering, acquiring a substantial amount of knowledge or skill in that specific market. Okay, and of course, being in a position where you are aligned with your goals. Okay, so moving on forward, where do traders typically falter in their market selection and execution? Clearly, one, it begins with a lack of education. Okay, so most of us, when we are beginning in this trading space, we are channeled into currencies, into trading the FX, because that is the most commonly known one. We do not even have the idea of there are things like options market, futures market. We come to know them later. And when you're coming to know of them later, you then realize, oh, perhaps it's like I even have a better inclination to trading the futures market and the options market rather than the currency market that I was directed to. Okay, so having a good understanding and a good education from the word go really helps you have a better stake when it comes to market selection and also execution. It is a very essence of this lecture series. And then another point where now a trader experiences faultiness when it comes to execution is over leveraging. So you take a market that is that has an inclination to a lot of risk, and then due to that market having the availability of leverage, you end up over leveraging there. And of course, leveraging is a blessing, and also is also a blessing, and also at the same time a curse. Okay, so it is a blessing if you know how to use it well, and it is a curse if you're on the wrong side of it. Then lastly, ignoring cost. So these four markets, there are differences in terms of the expenses that are accrued with each of these markets. So for instance, for the stock market, there are commissions. For the futures market, there are commissions. But when you come to trading the CFDs, there are no commissions, but there is a spread. When you're trading the currency pairs, there might be a broker who is giving you spreads, but then he's not giving you a commission. But then the others who are giving you a commission, but with zero spread. So it is upon you to understand really the matrices of each market and then position yourself well so that you do not find yourself on the wrong side later on. Then moving on forward, how do risk vary across futures, stocks, options, and Forex market? And this is very straightforward. For the stock market, the leverage is low, but the risk level is moderate. Okay, so if you are a person who is risk averse, okay, you do not love getting your hands dirty with a lot of risk here and there, the stock market is a good thing for you. For the futures market, there is a high leverage. We're using the contracts here. There is a high leverage, and also the risk level is high. Okay, so for the options, the leverage is variable and the risk level is high. For the Forex, it is very high and also very high on the risk level. So it is upon you to really weigh your personality and which trading style really fits you, and then you're able to choose the market that you are comfortable with. That is all that was prepared for you in this lecture series, in this lecture 2. And I am glad that you followed through up to this point. See you in the next lecture 2.